1. Start with energy, explain with authority, highlight with emphasis, end with warmth. The market is currently closed for the weekend, and Applied Digital Corp, ticker symbol APLD, has effectively planted its flag at 27.10 USD. During the last active trading session on November 28th, the stock surged by 2.16 USD, locking in a massive daily gain of 8.66%. In the after-hours markets, we saw a slight continuation, ticking up another 21 cents to 27.31 USD. If you are looking at these green percentages and thinking this is just another routine day in the AI supercycle, you are missing the forest for the trees. The expectation for Applied Digital right now, fueled by headlines on Yahoo Finance and chatter on Robinhood stock trading forums, is that this is a baby NVIDIA. Investors see the AI label, they see the partnerships, and they assume this is a pure-play technology stock destined for a smooth, parabolic ascent. The narrative is simple. AI needs chips, chips need power, Applied Digital has power, therefore, stock goes up. The reality, however, is that you are not looking at a standard technology company. You are looking at a high-stakes, leveraged construction project that is currently executing one of the most aggressive financial tightrope walks in the entire market. The gap between the AI hype and the industrial execution is where the danger and the massive opportunity lives. Applied Digital is not selling software code that can be duplicated for free. They are pouring concrete, negotiating gigawatts of power, and taking on billions in debt to build the physical nervous system of the future. The 27.10 USD price tag isn't just a valuation, it is a progress report on whether they can finish these massive AI factories before their interest payments eat them alive. To understand why this specific price point is critical, we have to strip away the glossy investor presentations and look at the gritty mechanics of what just happened in North Dakota. Let's dissect the catalyst that likely drove this recent 8.66% spike. It wasn't just a vague optimism, it was a concrete milestone. The company announced that its first 100-megawatt building at the Polaris Forge 1 campus in Ellendale, North Dakota, is officially ready for service. In the world of institutional brokerage, this RFS designation is everything. It means the difference between a hole in the ground burning cash and a functional asset generating cash. For months, the bears, and there are many, with short interest hovering at uncomfortable levels, have been betting that delays, supply chain issues, or grid connection problems would stall this project. This announcement was a direct punch to the gut of every short seller. It proves that the management team can actually deliver on the build part of their design, build, operate model. But here is where we need to apply our reality filter. While the 100-megawatt milestone is great, it is just the appetizer. The real story, the one that keeps risk managers at Interactive Brokers up at night, is the financing behind it. Applied Digital recently completed a massive $2.35 billion private offering of senior secured notes. Read that again, $2.35 billion. And the interest rate? 9.25%. That is expensive debt. In an environment where major tech giants like Microsoft or Google can borrow for next to nothing, Applied Digital is paying junk bond rates to fuel its expansion. This tells you exactly what this trade is. It is a leveraged buyout of the future. If they execute, the leverage amplifies the returns, and the stock could easily double from here as they refinance that debt down the road. But if they stumble, if Polaris Forge 2 faces delays, or if their mystery US-based investment-grade Hyperscaler tenant gets cold feet, that 9.25% interest coupon becomes a noose. If you are holding shares in your Fidelity brokerage account or actively trading this on Webull, you are essentially acting as a mezzanine lender to a massive real estate developer. The product isn't really the data center. The product is the speed at which they can deliver power. The reason this stock commands a premium and why it has rallied so hard is because power is the new gold. We are running out of grid capacity in the United States. It takes years to build new transmission lines. Applied Digital's moat is that they have already secured the rights to this power. They are sitting on a resource that is becoming scarcer by the day. This brings us to the Hyperscaler mystery. We know they signed a lease worth approximately $16 billion over its lifetime for the Polaris Forge 2 campus, but who is the tenant? The company hasn't explicitly named them, but the sheer size of the deal narrows the list down to 3 or 4 names. Is it Microsoft? Is it Amazon? Is it Meta? Or is it a dark horse like Oracle? The market hates uncertainty, yet in this case, the uncertainty is acting as a buffer. Investors are projecting their favorite tech giant onto the deal. The moment that name is officially revealed, we could see a sell the news event or a validation rally depending on the quality of the counterparty. Comment below. Who do you think the mystery tenant is? Is it Microsoft, Amazon, or someone else? I want to see your theories in the comments. Now, let's look at the short squeeze mechanics. I mentioned the short interest earlier. When a stock like APLD moves up 8% in a single day on news like the RFS milestone, it triggers a panic loop for short sellers. If you are short this stock, you are paying a borrowing fee to hold that position. When the stock rises, your margin requirements tighten. This forces the weaker shorts to buy the stock back to close their position, which drives the price up further, which forces more shorts to cover. This is the squeeze. The 27.10 USD price is likely inflated by this technical pressure. We need to see where the dust settles. If the stock can hold above $25 for the next week without collapsing, it suggests that real institutional buyers, the Fidelity mutual funds and pension managers, are stepping in to replace the fleeing short sellers. That would be the sign of a durable bottom. We also have to talk about the NVIDIA connection. Applied Digital is an elite partner in the NVIDIA Partner Network. They are positioning themselves to host the new Blackwell GPUs, the most powerful AI chips ever made. The expectation is that because they are friends with NVIDIA, they are guaranteed success. The reality is that NVIDIA is friends with everyone who buys their chips. Being a partner is a license to hunt, not a guarantee of a kill. However, having the infrastructure ready specifically for the high-density liquid cooling that Blackwell chips need is a genuine competitive advantage. Most legacy data centers can't handle the heat these new chips generate. They would literally melt the racks. Applied Digital's facilities are built from scratch with this liquid cooling in mind. They are not retrofitting an old warehouse. They are building a Ferrari garage for Ferraris. Let's shift to the financials. If you are using SoFi Invest or Schwab Intelligent Portfolios to look at the PE ratio, stop. It's meaningless. The company is currently loss-making because they are spending every dime on construction. You need to look at EBITDA, earnings before interest, taxes, depreciation, and amortization, and more importantly, operating cash flow once these facilities come online. The bull case valuation model assumes that once Polaris Forge 1 and 2 are fully operational, the company will be generating hundreds of millions in steady utility-like cash flow. At that point, the stock shouldn't be valued like a volatile crypto miner, which is its heritage. It should be valued like a high-growth utility, or a REIT, real estate investment trust. If the market re-rates APLD from a tech spec to an infrastructure compounder, the multiple expansion could be enormous. But we must respect the downside. The bear case is vivid and terrifying. If the AI bubble bursts, if companies stop spending billions on training models that don't generate revenue, the demand for these data centers could evaporate. Applied Digital is building capacity for a future that hasn't fully arrived yet. They are betting that the demand curve for compute will continue to go vertical. If it flattens, they are left with expensive buildings and massive debt payments. Furthermore, there is key man risk. CEO Wes Cummins is the architect of this strategy. He is a known quantity on Wall Street, which helps with raising capital. But if he were to leave, or if the management team gets distracted by other ventures, the premium baked into the stock would vanish. For those of you engaging in online investing and looking for a technical entry, look at the chart. The $20 level was a massive resistance that has now turned into support. The fact that we are trading at $27 suggests a breakout. The next major resistance is the psychological